Hi, my name is Eric Rosen, and I'm very excited to be here with Billy Libby today on the newest edition of the Founders Series, which is a joint effort from 3i and the Rosen Report. Billy, welcome aboard. How you doing?
Eric, thanks so much for having me.
I'm really excited. I get to do a lot of these podcasts with different people, and I love doing it when I'm with a close friend. So I think we're going to have a lot of fun today, and I look forward to hearing the story. So
Absolutely.
why don't you start with telling us a little bit about your professional journey and background, spanning from Penn Soccer to Goldman Sachs?
Sure, and I'll try to be brief so we can talk about more interesting things for the audience. But when grew up in the DC area, and my parents were always doing kind of entrepreneurial things, and my dad really always had worked for himself, and I had taken advantage of my summers in college to try to do different things. So I went to Penn, played soccer there. And one summer I worked at the White House under the Clinton administration. Another summer I worked in Hong Kong doing investment banking in TMT. And just when I graduated from school, really, I knew that I wanted to do something a bit more fast paced. And I was interested in technology and entrepreneurship. So as I was interviewing out of school, as you know, you kind of apply to a desk.
Mm-hmm.
And as a 21-year-old, I mean, how do you know of an FX desk versus LevFin versus,
Luck.
ISG sales? I mean, it's complete randomness. And Goldman was the one firm that said, look, we see a lot more of you than you see of us at this age. If you're the right fit for the firm culturally, we'll figure out where you're going to be the most impactful. And so they directed me to this area of electronic trading in 2003, which was building algorithms and building technology for hedge funds to trade in a more automated way and to build exchanges. My boss went to run the New York Stock Exchange, and that was kind of my first entree to technology and, following advice from people who have a lot more experience than you and trusting that will work out.
Wow, and that worked out well. That's amazing. What were some of the key decisions you made during that journey when you were at Goldman that you recall that may have helped your career?
I think going into areas that there aren't many experts in, it kind of allows you to get your hands dirty. As I've gotten older, I view myself as being a natural salesperson. And I remember when I started, my boss there, this guy, Mike Barini, who came from SLK, if you remember Spear Leads and
Yeah.
Kellogg,
Yep.
and it was much more old school, throw you in the
Yeah.
trenches, sink or
Yep.
swim. He said, look, you seem naturally comfortable with clients, so we're going to put you in operations, and kind of understand how things work and process and clear and bill. And I just think that experience of kind of understanding how things work back to front and really attacking each opportunity given to you with the same vigor, like helped me a lot understand how things get built. Most of Wall Street roles are really selling. And so kind of learning how the product side and operational side work, I think was very helpful to me.
Yeah, sales is key on Wall Street. Selling yourself, selling a product, it's important. So can you tell us about what exactly Upper 90 is and then how you came about founding it?
Sure. So I look back at electronic trading and quantitative trading, and it's it's very similar to fintech as people understand it today, right? You're looking at historical data. For us, it was stocks. Today, it's looking at people's credit cards and social profiles and bank account statements. But it's looking at historical data, predicting future prices, and using technology to do a lot of little events efficiently. So I always feel like my experience in Wall Street was very much in that realm of what we think of fintech today. And so I always, as I spent more time there, wanted to do something more in the tech world and leverage what I had learned. And one of the things that I found that was really difficult, and maybe this resonates for you or a lot of people, like all the skill sets that we learn in finance are not necessarily valued in the same way in the startup or tech world. So you could go be like a VP of capital markets at Stripe or work in the treasury group at Microsoft. It's almost like you have to like start over in tech. And that's really where I felt the world was going. And I wanted to get closer to that world after my experiences on the banking side. So I said, how do I take my skill set and bring it to that world? And I met a gentleman, Jason Finger, who started Seamless Web, which then merged with Grubhub. And one of the things that he highlighted to me is that when he started Seamless in the late 90s, VC firms were very small and very aligned with management. Like, they were writing smaller checks, they cared about dilution. And if you fast forward to 20 years later today, VC and growth equity has gotten gargantuan. They're writing bigger and bigger checks. And what's happening is founders are owning less and less of their business, and they have less operational control. And he said, there's a missing piece in the startup financing world. Like, equity is the tool. And VC as a model really hasn't innovated itself. And so, like, my background and looking at data, and Jason's background working in, venture capital in the startup world, we brought those two skill sets together because I think you need to look like your customer. You need to have connectivity with that world, which he has. And, for us to think about providing credit, we need my background. So we started Upper90, and the real mission was, how do we find interesting businesses that have an asset where equity is being used, where debt is appropriate, versus raise equity, get debt, which is kind of the, venture debt model that's been in place for a long time. So that was really the impetus. And it was exciting for me to figure out I could kind of take my skill set, partner with somebody who had a different skill set, and like 1 + 1 is 3.
That's great. So give us an example of a recent deal that you thought was interesting or innovative or something that is illustrative of what you're doing.
Sure. So, the one thing that's interesting is everything we do now is captured in data. The Instagram ads that you will see will be different than what I see, and the Netflix home screen, like everything in our lives will become personalized. The balance sheet of companies has really not changed as equity. So some specific examples, there's a company that has built now the largest driver's education school in the country called Coastline. We met them through one of our LPs when they were thinking about their Series A. So they had built a tech-enabled driver's ed school. So an app to connect students and drivers, and rating drivers, and giving, upsells like defensive driving. So a really kind of tech-enabled approach to a very legacy mom and pop business. They were profitable, they were scaling, they were looking to raise venture capital and growth equity. And when we met them, we said, what are your uses of capital for this big equity round you're raising? And they said, well, half of the round's going to be leasing and buying Toyota Priuses for the drivers' teachers. Mm-hmm. And half of it's going to be, marketing, technology, and personnel. And like, why would you use equity for something that is a very well understood asset? And so we gave them a credit facility to finance the Priuses, and they were able to grow, raising about half of the equity that they had planned to do.
So less dilution for the founders, which you hit a point before. I work with all these companies, and I sit on boards, and as you said, founders used to own an overwhelming majority of their company. And now I'm talking with founders that are on Series A and they're down to 10 or 15%. I'm like, just the math doesn't work. You're going to keep getting diluted. You're going to be down to nothing by the time you're done.
Well, I also remember one of the whiteboards from one of my bosses back in the day was like, go big or go home. And I think what's happened is, for founders, if you don't own enough, then why not go big or go home? And so like in Coastline, they still own the majority of their business. If they have a $100 million exit, that would be the equivalent of a traditional Series D venture company having a $1 billion exit for the management team. They own about 5% at that point.
Yep.
So I think it also opens up the realm. Like, our Upper90s capital helps have a lot of different outcomes because doesn't have to be binary. Like,
and what was the rate on that loan, and what was the kind of LTV against the fleet, just so people know?
Sure. So usually we're pricing risk, or our cost of capital is usually like low to mid-teens current pay. With rates rising, it's probably closer to 15%. When we put our firm together, we're like, life's too short. Most lenders are very temporary partners. They're in, they're out, and we want it to be aligned with our company. So we do about 90% debt, and we'll do 10% equity. So we'll actually put money into the company, to create a different level of alignment. So, I think we're looking for companies where we feel like the asset can self-amortize. It can pay back the debt. And for a Toyota Prius, which is a very well understood asset, you might have an 85 to 90% advance rate on, what you believe the values of that car. Another deal that we just did is a company called Crusoe Energy, which is capturing stranded gas from oil fields in the country where there's no pipeline. So they're drilling for oil in Colorado, North Dakota, Montana, et cetera. Then the oil gets shipped out, but the natural gas gets flared because there's nowhere to put it or export it. And so Crusoe built portable data centers that are going to these oil fields, capturing that energy that's being wasted and repurposing it. And so in that situation, we're actually financing. They're now doing cloud computing and AI. The biggest input of that business now is energy. And so we're financing their acquisitions of the latest generation NVIDIA chips. Now, clearly, that's an emerging industry. The technology obsolescence is unknown. So we'd say, hey, the advance rate for a product like that with a lot more volatility is maybe 50% or 60%, not 80 or 90%. But I think a lot of people get fixated on, hey, why would somebody pay 15, 16% for, financing used cars, when Hertz is getting 5%. And it's like, the question is, well, they were about to use equity.
Yeah, it's a lot cheaper than equity.
Yeah, and I think it's kind of helping
dilution.
people understand the options and, alternatives.
So what are some of the lessons that you learned in Upper 90 that helped influence the idea for 3i that you launched with Mark and Teddy?
Sure. So Upper 90 started as a club. So I was at dinner with Gerson, and he said, as a tech founder, I invest in really interesting startup opportunities. Founders want me on the cap table. And so he said, I love the deals because I'm seeing them first and I understand them, but my net worth is 0 to infinity. And so I'm a big believer that you should be investing in deals that you should be seeing. Like, why am I seeing a tech deal, at the time? And I mostly invest in, market making strategies and quant strategies. And those are much more liquid. And it's like, hey, I, kind of have very active P&Ls and redemptions. And Jason's like, how do I access quant deals? I want more liquidity. I didn't know that existed. If a quant deal comes to me, it's probably like, an ETF or an AQR, which is like a behemoth, not, GTS or some really interesting high sharp market making strategy. And I was like, if I saw a tech deal, like how many people passed that somehow it's gotten to Bill Libby, so Gerson said every tech founder that I know would want access to your deals. And I said every quant founder that I know would want access to your deals. So we both invited the 10 most interesting people from those verticals. We all put in money and we all shared our deals. So this is how it started. We went months a month. And what happened is by bringing together, I'm a big believer, like opportunities are created when you bring together two areas that don't overlap. Like I'm sure in finance, there's prime brokerage and there was program trading. The hedge funds started doing program trading like Millennium, and all the banks got into prime brokerage, stock loan. And then Goldman's like, hey, well, if we bring those two businesses together, we can do a swap business that others can't do. So we brought these two random groups together, which I think has a lot of the ingredients of 3i. It's like bringing experts from different areas and new opportunities come about. And what happened is the real change is happening in the tech world. And all those opportunities came in from that world. And the quants kept asking like, hey, why is this company raising equity? They had all the data. So it's kind of, that's how it started. And then as Upper 90 gravitated towards, and we grew and we had to kind of specialize, it was on credit, finding asset-backed loans and receivables and royalties. And Mark and I were saying, hey, there's just so many other things that are still interesting opportunities that don't fit in the box. And it's a shame to let those go. And like, there's also a lot of experience and learnings that should be compounded it, where if you're doing X, like you moved to Florida, that process, why should someone go through that again? So I think once Upper 90 got bigger and specialized, Mark said, hey, let's go back to like where it started. And there's just like a lot of elements there that are its own thing between his experience at GLG and in mine with Upper 90.
That's great. And so in terms of 3i, what are you most excited about with respect to where it is today?
Sure.
A couple years in.
So I think when it was launched, it was very much like in that investment club mentality that we just mentioned. And that was really, I'd say, the primary, hey, I want to find, under the radar opportunities and I want to learn and piggyback on experts in areas. And what I think excites me the most is there's always another deal, and I think in COVID and as people have exits, it's creating a community, creating a network of people that are like-minded, that want to build, that want to help one another. I think the community part of 3i that brings people together and helps solve problems for member that like extend across their life, to me, that is very sticky and that's very hard to create and is like a missing fabric. And that to me, I see being like the majority of the future value, with an important but minority part being like finding deals.
I agree. I've been involved since the beginning, and I've made a lot of new friends. Yes, I've invested in a half a dozen deals, but I would say the network and the friends I've developed. Teddy was with me over just a couple weeks ago. He was in town. Jacques Friedman comes over. I have all these people that I didn't know a couple of years ago that have become good friends, and we do things outside of 3i as well. So I'm a big believer in a network effect and growing the network, and I think it's done just that. So kind of on a related topic, we touched on how venture capital has changed over the last 20 years, and there's been kind of a reset. A lot of 2021 deals and firms are toasted, right? I mean, they lost a lot of money in light of paying super high valuations. Where do you think it goes from here on the venture side?
Sure. And I think you just made a great point. Like the best deals in my experience have come from trusted people. And when you're meeting new people, or you're comfortable or I'm comfortable introducing someone to the network, like you have to do that in a curated, trusted setting. You don't want to bring your decade-long relationships into an unknown market. So I think all these things need to be highly curated, and just bringing people together to solve problems. On the venture capital, I think the biggest shift is when we started Upper90 in 2018, it was the same thesis, how to think of providing more tools to founders to grow their company on the capital side. The services that were provided by VCs at the time, and I think Gerson kind of led this, like, we'll help you with marketing, we'll help you with customer acquisition, we'll help you with, people. Like those have become available from the market. There's tools now, there's Greenhouse, there's people are using those in-house. So we felt like the next set of tools that are important to founders are going to be capital markets tools. How do they think about tax? Most founders don't think about like setting up for maximizing QSBS and how to do trusts. And, everyone kind of deals with all these things after, and it's like a huge problem. So like our view is a capital market services, which debt is a critical part of, are the most critical and, going to be in vogue. Now, when we started, equity was cheap. Valuations were crazy. So our biggest thing was like educating the market on credit, and when to use alternatives. Now equity is expensive. So obviously it's in vogue. I think the biggest change you're going to see is twofold. I think you're going to see founders that are comfortable building a kind of cash flow positive business that doesn't need to be a unicorn. Like they don't care if they have brand name VCs. They just, they want capital, they want to get to profitability, and they want to control the destiny of that journey. So I think you're going to see a lot more businesses that are like low to mid market, not this unicorn path. So I think it's going to open up a new, and those will fail too. Like I think someone joked like, the top profession now leaving Stanford Business School is like going and owning a plumbing business in Iowa. So there's some middle ground, but I think you're going to see people like not chasing kind of these illusory outcomes, getting to profitability. And then I think you're just going to see some of the bigger funds getting bigger, like you're seeing in private credit and in the hedge fund world, where they're just going to like lower fees. I think it's going to be really hard for the single manager or the group of people who thought it was easy and, left a big place and, got lucky quick. So I think there's just going to be it's going to be really hard to be a small player. And I think founders are going to be like open to running a profitable business versus like a unicorn outcome.
So a couple of things you said. So on that point, I agree it's getting crowded, but with the banks pulling back and lending, and the regulatory environment, I think there's some cool things going on in private credit. And you said something else. You mentioned QSBS. So I didn't know what QSBS was 7 or 8 years ago. And actually, Mark Gerson, we were making an investment. He goes, well, make sure it's QSBS. I was like, what is that?
Right.
And, qualified small business stock, I think is what it stands for.
Yeah, exactly.
And for those listeners who don't know what it is, there's some rules that if you make an investment in a small company that has less than $50 million of assets and its valuation is, and there's less than a certain number of employees, you can invest and you don't pay tax on a big chunk of the capital gain if it's qualified as if it qualifies as a QSBS and you hold it, I want to say 5 years or something. So there's these rules. So if you're making investments in small companies, you should look into the QSBS designation with your CPAs, with your tax advisors to see if you can do that. It might save you money. And I learned that trick from Mark.
And I'll just give you one example because Jason's very focused on, just post-tax returns is the term we focus on.
Yeah.
I think QSBS, we're not experts here, but it's like your first $5 million is tax-free if you hold it for 5 years and it's an early stage business. And then you could set up 5 trusts where each one of those trusts have a QSBS exemption. So that's now $25 million. So like for a founder, most of them are on the cap table in their name. And these are ways that we want to help think of giving more insight early.
And then even as I think then it's like phases in over time. So until you sell for like 50, 60, 70 million, there's some material tax savings, which is interesting. So, exactly. Okay. So what comes next for Upper90? What are you excited about with the future of Upper90?
I think, there's periods in your life where you think about strategy and growth, and there's periods in your life where you put your head down and grind. And, I still feel like the private markets take longer to work through than the public markets. And, we spent a lot of last year proactively merging companies, and, we've never been like an AUM minded gatherer. And so we've refinanced, I'm proud both of our first funds, like 2018 has over 100% DPI, like 2020 is almost 50%. So it's like kind of knowing like how to refinance, when to refinance. And I just think so much of last year was kind of like portfolio management. And I still think there's more things coming to the private markets, but I feel like just feels entering 2024, people are going to have to do things. There's going to be financing rounds, like maybe some of the capital markets open up a bit. Like I just more optimistic that it's now refocusing on like investments. And one of our portfolio company founders, Jason Gus from Octane Lending, said, hey, if you're a startup with a complicated capital situation, usually mid to later stage companies, like check with Upper90. So I think we're seeing a lot of companies that have like an interesting problem to solve, that are later stage businesses. And before, the markets were so flush that if you didn't get in early, like the companies just never needed you. Yep. And so now I kind of am excited to solve some of these later stage problems. Maybe the company is merging or doing an acquisition or buying back their business, or, hey, a bank was going to close and it's taking longer. So I feel like there's going to be a lot of these more special sitch and bridge capital situations this year. And that's where we're focused a lot more.
And how much of your what you're doing is actually within the fund versus co-invest?
So everything that we do starts with the fund. We're trying to do, asset-backed senior secured facilities that are somewhere between $5 to $25 million in size, which it's a nice spot for us because it's kind of too big for the family offices on average and the friends and family. But it's, once you're doing $50 million deals, everyone's looking at them. So that's where we typically start. And if a company wants to keep growing with us and has found product market fit and has good margins and spreads, like then, we want to be diversified in our fund. We will set up co-investments to add to our positions in our fund. And when we were smaller, it was almost like maybe 3-to-1 co-investment to fund investment. It's probably more like 1-to-1 now.
Great. Okay, so talk about one of the unexpected stories you had with 3i that you think is memorable for the viewers.
There's a couple things. I haven't thought about this question that much, but some of the things that come to mind. One is a lot of the people that I've developed relationships for a long time I didn't expect them to join 3i and meet so many other people. Like I've just
Yep.
been like, Jacques and some of these other people that I've known for a while. Um, I've just been surprised at like how quickly relationships have been built, and like the range of topics that people are working together on, from I left my company and I need an insurance solution. And it's like 30 members are like, I would love to find an personal insurance solution. Or, everyone's figuring out how to like buy treasuries and how to diversify to get the best yield. And you're like, here's like what I do for myself. And just like compounding in life is amazing. And I've just been amazed at like when one person does something, how relevant it's been to many other people. And then I've never really gone to the Warren Buffett conference, Berkshire Hathaway conference. And one of our members has a really choice set up there. And so this year, I'm going to be going with 15 other 3i members, in a really high class way to see this great conference, and something that I probably never be able to set up on my own. And then going with 15 people that I want to spend time with. So that's something that, time is like the most valuable thing. And that to me is like a win. It's like you're doing something and you're meeting new people, and you all have some natural commonality through 3i.
I agree 100%. I've really enjoyed it. I spent a lot of my time with 3i, getting people involved and, speaking with people and educating people about my move. So it's been fun. I really enjoyed it. Well, Billy, as I said, I enjoy doing these podcasts with everybody, but when you get to do it with a friend, it's really nice. And you and I actually met through the 3i process to become friendly. And I'm actually going to see you in Miami. You're coming to the bright side of the world in Miami in a couple of weeks, and we're going to have dinner
the 29th and the 30th. And it's been fun to watch the Rosa Report grow, and how there's just all these little connectivity points. But you need to have someone said something very interesting to me, like community. As religions become less and less core to people, like a lot of people find community through fitness, actually.
That's right.
And I think to find business community, it's hard, and so I think it's nice to talk about things and work together on things, but it's easier said than done. So especially in a distributed world.
Well, yeah, I always end my things. I put on a Rosen Report hat, and I put this on in the end. But it's been a really pleasure. It's been my pleasure to be with you for the last 30 minutes or so, and I look forward to seeing you in a couple of weeks. So thanks for joining the 3i Rosen Report Founder Series, and I look forward to seeing you in a couple of weeks.
Thanks so much.